The Indian stock market recently surpassed $5 trillion in total capitalization, officially making it the fifth largest equity market on Earth. But as a foreign investor, you cannot simply open your domestic brokerage app, search for an Indian ticker, and route a buy order. Accessing this market and its historic physical infrastructure in Mumbai requires passing through a highly specific regulatory gate. We are going to map out the exact legal framework you need to bypass that barrier. By following these steps, you can establish compliant accounts and execute your first trade within 1 to 3 weeks. Before you begin, you need 2 prerequisites ready to go: a valid government-issued identity document and a tax residency certificate from your home country. India enforces this complex setup to protect its domestic economy from rapid inflows and outflows of foreign cash. By learning to navigate this friction, you secure a structural advantage over average retail investors who are locked out by the paperwork. Step 1 is defining your legal investment route. The Indian government categorizes foreign capital based on your heritage and corporate status. If you are a non-resident Indian or a person of Indian origin, you take the portfolio investment scheme path. This route is reserved exclusively for the diaspora and provides specific repatriation benefits. If you have no Indian heritage or you are investing through a corporate entity, you will use the Foreign Portfolio Investor, or FPI, route. Do not attempt to bypass direct registration using participatory notes to trade derivatives. Regulators have explicitly closed this loophole, and derivatives exposure through P-notes is now strictly banned. This illustrates the critical limit for the FPI route, the 10% threshold. If you buy more than 10% of a single company's shares, you cross that line. Your status automatically shifts to foreign direct investment, triggering heavy government scrutiny and complex compliance burdens. Step 2 requires gathering your documentation. You submit the Common Application Form, your tax residency certificate, and 3 years of audited financials. Submitting a pristine application under the correct legal route acts as a legal shield, ensuring your overseas capital is recognized by regulators and remains liquid. Step 3 is appointing a custodian. Foreign investors are legally prohibited from executing trades directly on Indian exchanges. You have to route your capital through a SEBI-registered designated depository participant. You will need to partner with an approved institutional intermediary, such as HDFC, ICICI, or BNP Paribas. Here is the mandatory 3-account architecture. Your custodian links your foreign bank account to a special non-resident rupee account, converting your funds to local currency. Then, that rupee account links directly to your Indian Demat account, the secure digital vault where your shares are held. The Indian government mandates this bottleneck to ensure strict banking compliance. Once your money is inside this protected triangle, your trading activity is fully recognized and secured by the state. Step 4 brings us to funding and execution. You physically wire your capital from your home country via SWIFT directly into your new rupee account. You must attach the exact FPI purpose code to your wire transfer instructions. Without this specific code, the local bank will reject the transfer and bounce the funds back to you. Once funded, you place your orders through your designated platform. Trades executed on major hubs like the National Stock Exchange settle on a highly efficient T+1 cycle, meaning your shares clear exactly 1 business day after purchase. Step 5 is preserving your returns. Generating paper wealth in India is a wasted effort if you lose a massive percentage of it to tax leakage upon exit. This table shows your dual capital gains tax liability. Hold shares for less than 12 months and you pay a 20% short-term tax. Hold them for over a year and that rate drops to 12.5% on qualifying gains. To mitigate withholding taxes on your dividends and interest, you need to file Form 10F. This document applies your country's double taxation avoidance agreement, ensuring you aren't taxed twice on the same income. Finally, before routing any buy order, manually verify the sectoral investment limits. Certain industries are heavily restricted. Foreign ownership in telecom, for example, triggers strict government approval processes once it passes 49%. Calculating your tax brackets and monitoring sector limits ensures that the gross portfolio returns you see on your screen actually translate into net profits you can legally wire home. With your compliance checked and your accounts linked, your funds have cleared, your Demat vault is active, and you are fully authorized to trade. You can now access your dashboard, analyze the order book, and execute your order on domestic Indian equities. You have successfully built a compliant bridge that gives you direct access to a rapidly compounding, digitally native economy with over 1 billion consumers. To get started, review the official list of SEBI-approved custodians and initiate your designated depository participant application today. India's regulatory wall requires precision, paperwork, and patience. But that friction serves a purpose. It filters out casual tourists, leaving the massive economic upside available entirely to the investors willing to lay down the proper infrastructure.